This? No. What was it? Okay, there we go. Where was that audio coming from? Oh, okay, cool. It's okay, complicated. Right. I was just about to say, how is it going into? Okay, got it. Okay, got it.
So what are the when you add in the line, you've got a bunch of
I would never be able to do this. Maybe I would, but yeah.
Ladies and gents, thank you very much for coming this evening. Apologies for still across the road. The refurbishment was going to take 6 weeks. It didn't take 6 weeks. No one looks surprised. One day we'll get back into the real building. So this evening I'm not doing the presentation. Moxima Gama is going to be doing our presentation. She came last year, she did a technical analysis, applicated this year, taking it up to the next level. As always, I mean, I think Moxima is one of the top charts in the country. She does it old school, she doesn't great. You can make a chart saying, oh, what's good moon rises on the chart? It sort of told me things, and it did for a while, and then it did. So we need to be a little more smart than that. But Moxima, all yours.
Thank you, Sai. Thank you for coming, everyone. I appreciate this. As I said, we're going to be looking at advanced technical analysis, but I'm going to talk you through, which you probably know, but just to recap on the basic part, really going to squeeze through that. And then we'll get to the advanced technical analysis section, which will then help you understand why things get complicated when people trade. People like, as I say, I like keeping it old school and simple, but most traders, they just, to make money, like what else can be done with us? So they've created all these other indicators that are made to help you. And I'm just going to share a few that are popular, but there's a plethora of them out there. And you just have to choose one that really works for you. So we're looking at advanced technical analysis today, but I'm just to kind of get it out of the way for people who probably don't know technical analysis. I've asked the question, why do people use technical analysis when investing? And it's pretty simple. It's because they want to predict future price movement. And they do that by studying historical prices, current sentiment, and volume data. I don't really look at volume as much, particularly if you're doing a long-term investment, but day traders, you know, whether you're a swing trader, they tend to look at volume. I would only look at something like VWAP for volume if I'm doing a day trade. If I feel like this is an opportunity to get in, I then look at VWAP. But technical analysis is just literally looking at what happened. The term history repeats itself. It's looking at what happened in the past in order to predict what's going to happen in the present and the future. So it helps traders identify trends, if it's in an uptrend or a downtrend, because obviously if you know if it's an uptrend, prices are going up, optimism is high, investors are buoyant, or just even about on the currency or anything else you're trading, or if it's going downwards, it means they're obviously pessimistic. But it also helps them find entry and exit points. And I think this is the biggest flex when it comes to technical analysis, knowing at what price to buy and sell, because without knowing that, you're literally trading blindly. So by applying technical analysis, you find a level and you actually wait for the level to be breached before you. So another thing, you exercise a lot of patience. I've learned a lot of patience trading with using technical analysis, but it finds potential entry and exit points, and it's just generally gauging market psychology and capitalizing on that momentum, whether it's a trend that's going up or downwards or there's a reversal, but that's what it's all about. Now, what it effectively helps you to do is know whether to buy, sell, or actually just stay out of the markets. And if you're looking at a chart and there's what they term now as confluence not really giving you any signals, you learn to just stay out of the market until you find proper signals that say it's time to get in or get out. Is it the only methodology for investing? The answer is no. You all know that there is also fundamental analysis, but the difference is technical analysis leverages on the directional movement. It's big based on the market sentiment and real-time decision making. Whereas fundamental analysis just looks at the asset's intrinsic value. How are the organs of the company? Are they healthy? Is this whole company healthy for me to actually invest in? Or economy or whatever financial sector they're looking at. Now, do they work well together? I'm not married, but I'm told that there are a lot of arguments that happen which either could delay something, an entry, or delay the end of something. But when there is a good union, technical analysis and fundamental analysis, when they marry and there's that perfect union, your investment smiles at you. But initially, what technical analysis will do is help you with timing. And by the time fundamental analysis then sees that, oh, the organs of this company are actually healthy, technical analysis, that's when the markup phase of technical analysis then comes in, and that's when a lot of other retailers. So the whole aim with technical analysis is getting in at the best price at a discount and selling at a premium. Okay. Now the difference between basic and advanced technical analysis, because there's technical analysis and technical analysis 2.0. What I will quickly squiz through is the basic technical analysis, just to jog your memory in case you forgot. It's just about trend line drawing. That's the first thing you need to be able to know to do when you're using technical analysis, as well as being able to identify support and resistance levels. Now, just to jog your mind again, the support level is where prices just generally bounce, like a floor, like a ball that bounces. And in most cases, most traders find that as good buying opportunity. You've heard buy low, sell high, so they would always kind of buy when the support level is identified and you see prices rise. And it's often seen as a selling level when it's breached from the lower end. So, and when that happens, that support then becomes resistance, and you do not delete that line, like you carry it through, because as you know, historical movement will influence what's happening presently or in the future. The same rings true with resistance trend line, which would act like a ceiling where, let's put an example of a ball where every time it goes up, then it bounces back downwards. So for most traders, they would find that as a selling opportunity. But when it is breached, as you can see, then that would give a sell signal because you're selling on the high. But once breached, it then becomes a buy signal for most long-term investors, even day traders. So they would probably get stopped out, and then they get into, because then they would know that sentiment is currently changing. But when that resistance level gets breached, that resistance becomes support, and you follow that line through. When it comes to trend lines, it's simply identifying a change of character or change in sentiment. There's an uptrend and a downtrend where you have your higher highs and your higher lows in an uptrend, and in a downtrend where you have your lower highs and your lower lows. And most importantly, it's those trend lines that you draw, because I don't know, I love trend lines. Without trend lines, I am completely directionless on what is really happening. And by drawing the trend lines, you actually know the end of one sentiment and the start of the next. If a trend is still within a particular trend line, it means that sentiment is still lingering until it is breached. I always say you never act on a trend line breakout, because you can have a false break and reversal. What you act on is when your support or your resistance level is breached. So once you've drawn your trend line, you identify your support and resistance, and that's what you act on, not on a trend line breakout. Okay, so the resistance, Sai, do you have that little red thing that, no. Is it, oh, oof. Oh, is it this one? No. Battery, okay, okay, cool. So the resistance trend line would be the one that connects the falling tops, and the falling tops, and the support trend line would then connect your falling bottoms. All play very significant role, because once the resistance trend line, particularly in a bear trend, is breached, that then means a change in sentiment from what was pessimistic to optimism. But the thing is, when the support trend line is then breached, it then means that the downtrend or that sentiment is now becoming aggressively so. And in most cases, the trend becomes steeper. So by drawing both the trend lines, it then gives you an indication on whether there is a change in sentiment or if that sentiment is becoming deeper or even more aggressive in what they're thinking. So that's just basically what trend lines is. Basic technical analysis, being able to draw your trend lines and to identify your support and resistance. Then there are basic technical analysis indicators that are out there. And the most common one would be the moving average, moving averages, and my favorite, RSI, relative strength index. Now, let's start off with the moving averages, which I'll also squeeze through. I'm sure you probably know, but I just want to show you the basic part of it. What it does is it's used to keep track of price trends. So this is basically how it looks. What it does is smooth out the trend itself. So you're concentrating on just that moving average, but it's not just about that. It also gives you signals to buy or sell. And how a moving average is a simple calculation. If it's a 10-day moving average, it's 10 prices. It's, 10 open closing prices divided by 10, and then the next day you add that one and the other one falls in. And then you get the smoothed out line that removes. So if you just squint your eyes, you'll just see if it's a bull trend or a bear trend or something's trading sideways, okay? Without all these noisy candlesticks that form. And if it's going up, if the moving average is going up, it obviously means that momentum is prices are going up. But if it's, if it's starting to dip, it means prices are declining. Now, some traders or long-term investors tend to use two moving averages to give you signals. And the reason for that is it helps identify potential reversals by comparing your fast-moving one to your slow-moving one. So in other words, traders would then use a crossover of, for example, your 10-day moving average or 20 moving average to buy or sell, right? And just to explain that part, the most common moving averages that are used out there is from 10, 20, 50, 100-day, and 200-day moving averages. Your 10 and 20 are the ones that be used by traders mostly. I tend to use 20 and 50, but for a more longer term investment, it would be 50 and 20, 50 and 200-day moving average that they would use, because they're there for a longer term when it comes to investment. If we just concentrate on the 20 being the shorter period and the 50 being the longer period, the crossover of those two then gives you signals. I wouldn't suggest you go anything lower than 10, because then it's just kind of tracking the movement of the price, which is fruitless. It defies the purpose. So when the shorter period, for example, your 10 moving averages crosses the longer period, that is then known as a golden cross. This gives you a buy signal. So most traders, when they see that, they then plot what their resistance or their support is, and then they know at what price they should then get in. And if the opposite happens, where the shorter period then crosses the longer period on the down, from up downwards, that's known as a death cross, giving you a sell signal. So traders would literally be waiting for this crossover to happen. And if the crossover is not happening, they will stick to that trade. So if it's giving you a buy, they would stay long until the death cross comes in, and then that's when they will short. Okay, so that's the two moving averages explained. Let's get to the relative strength index, which is my favorite, as I've mentioned. That is basically that chart there, and it's developed by J. Wallace Wilder Jr. It was in the 1970s, just recently actually. And we are looking at the bottom chart. So the top chart would be seen as the price chart, and then there'd be the bottom chart there. Now, this is a momentum indicator that measures the speed and the change of price movements. It's a complicated calculation, which you gladly, don't worry, you don't have to do it. But what changes is the period in which you're looking at. I would suggest everyone looks at a three period moving average, particularly even if you're trading in a long-term investment, because everyone else is using 3. I mean, 14 won't give you the information you need unless you're really there for a long term, but 3 is what most traders use, and because we're trying to study market psychology, we need to know what the others are doing, right? So 3 period is my suggestion. It could range from 3, 7, 14, and 21. I'll just say stick to 3. So it's very useful in showing when assets are either overbought or oversold, which is really what you want to know, because not only does it say that, it says to you, is it the time? It's kind of like, is it the time to buy now? And if it's overbought, then it's not the time to buy. And if you're trying to sell, and if it's oversold, it's not the time to sell. So I like it for that reason, that it's able to give you those extremities of just wait a little, there's going to be a pullback, or just wait, there's going to be a rebound. Now, it helps identifies reversals and indicates, as I said, if it's a good time to buy or sell at that specific point in time. Because there are many instances where your resistance level is breached. Because when your resistance is breached, it gives you the buy signal. But if your indicator is overbought, it says don't do it now. Because what happens is, okay, let me just explain the RSI before I get into that. It oscillates between 0 and 1, and the key levels that you're looking for is a 70-30 or 20-80. Most charts default to 70-30. I would suggest you change that to 80-20 because most traders ubiquitously use that, and you're trying to see what those traders are doing. I also feel like 70-30 kind of gives me false signal, not false signals, but just too early of a signal. But 80-20 just works better for me. Now, that area where the RSI is trading below 20 then means below 20 or 30 means it's oversold. And if it's above 80 or 70, it means it's overbought. So that's what generally you're looking at. Your ideal time of trading is between 80 and 20. That's the time when you can then take on position. So if your resistance or your support level is breached and your RSI is trading between 20 and 80, then with all means, go ahead and go large. Just don't do it when it's in its extremities. Now, overbought, just to explain that even further, if you just look there and on how it kind of works, when it's overbought there and you look at the price there, it does generally fall. So when most traders are seeing, or investors are seeing this is overbought, it is followed by a pullback. You could see it there as well, pullback. And there you would know I should anticipate a pullback. So for traders, when it is overbought, it then becomes a selling opportunity. But for an investor, it says to you, don't get in now, it's at a premium. Okay, so wait for it to pull back. Oversold, as you can see, it's below 20 and there, and the prices do go up. Oversold there, prices do go up, and the same applies there. For traders, it's usually a buying opportunity when it's oversold. So they would start buying with the anticipation that there will be upside, and there truly is. Sometimes I think it's such a self-fulfilling prophecy because we're all looking at these overbought or oversold, but it works, okay? It at least makes you that money. For investors, if you're trying to sell your share, never try and sell it when an RSI is oversold, because you're obviously selling it at a discount. You want to sell it at a premium. So if you're trying to, quickly sell something that's fallen and is oversold, you just have to grit your teeth and wait for it to rise again before you then make the decision to sell. So that's how the extremities of both oversold, and that's how they assist traders to make money, or the timing of when you should be entering the position. Now I'm going to quickly just show you using basic technical analysis to make these trading decisions, and I'll start off with just the simple RSI there. First of all, we have to start off with drawing our trend lines with technical analysis, because they assist in identifying a change in sentiment. So that's obviously a downtrend. That breakout of the trend obviously means that sentiment has changed from what was pessimistic to optimistic. Okay, then and then you see that upside. Even within the trend becomes steeper, and when it becomes steeper, particularly if you concentrate on this particular part, that's why I like drawing both parts of resistance and support, because the trend then becomes steeper when the upper slope is breached, as I mentioned, in an uptrend, or when the downtrend. So when this part gets breached, it then means that sentiment is becoming even more bullish. But when the lower end is breached, it then tells you that sentiment has changed. Okay, now the next thing you want to do, okay, you've drawn your trend lines, is now identify where your support and resistance levels are. When I draw my support and resistance levels, the first thing I do is I go to the monthly chart to inception of when the share was starting to trade, because that information is important to me. If it was a psychological in 1930 something, it will become a psychological level in 2025. Okay. So the reason why you're drawing those support and resistance, because it gives you those buy and sell signals. So there you identify where your support and resistance is. Because of course, if the resistance is breached, it means the upside, particularly in an uptrend, it means the upside is continuing. But when the support is then breached in an uptrend, it means sentiment is changing and you need to get out of that investment. So for instance, if that was breached, that would have given us a buy. But instead, it encountered resistance there, which then resulted in the support level being breached, giving us a sell. That would have given us a buy if it was breached, but instead support was breached, which gave us a sell, which then every time when support is breached, it tells you that the downtrend is still in place until such time as there's a turn and what was support becomes resistance is breached, and that's when you know trend is changing. That there would have given a sell if at all the downside was continuing, but instead the upside, the resistance was breached, which gave us a buy signal, and that's the upside we've been experiencing. This is just simple technical analysis without using indicators or anything. Now, when we start using the relative strength and the RSI, that's after you've drawn your trend lines and you've identified your support and resistance. You then want to look at areas that are overbought in order not to be buying when it's overbought. Okay, because when it's overbought, the price is going to fall. So when it is this overbought, you then are waiting for a crossover. So the price crossing over, and I'm using a 10-day move. I'm using, that's a month, so that's a 10-period moving average. So that crossover would then give you a sell. And as you can see, the price generally, I mean, and once your support level is breached, so you have, this is known as bearish confluence, where your RSI is giving you that, okay, it looks like this is going to fall. Your moving average, or your price is now crossing your moving average, and your support is also crossed. Those are three big signals that are saying, look, you're not supposed to be buying. And if you're buying at that point, I mean, just take a break. Like, if you're not following what the indicators are saying, maybe just choose something else. Don't trade. Don't try and go against what the indicators are saying. Okay, so that bearish confluence gives us a sell, and there's downside. And in that, with that oversold area, as I said, for a day trader, it gives you a buy. But an investor would only buy when resistance is breached. And it starts trading sideways, creating a bit of support there. But notice that the moving average is not really great when the market is not trending, when it's sideways. It gives you whipsaws. It's called whipsaws. It gives you buy, sell, which is a bit annoying. It's thrilling for day traders, but not just for a long-term investor. So what you ideally want to do is then put your support and resistance to know when you should be buying or selling in that sideways movement. And funny enough, the RSI does an excellent job because it's a leading indicator, which means it tells you in advance what the price chart is going to do based on its calculation. That will literally tell you that expect a potential upward break or a downward break. But in this case scenario, even in that sideways movement, when the price breaches that moving average and breaches your support, that gives you a sell over there, and so onwards. So that's how you use both the basic trend lines, your support and resistance, with the RSI guiding you on whether it is a good time to sell or not, and the crossover effect of the moving average. It sounds very complicated, but once you get into it, you then start understanding. And I've always said you have to practice a few times. And by the time when you look at your chart, sometimes it will just pop and you just know what to do. Okay, that's where that's with the crossover there, where the price then crosses over the moving average, gives you a buy, and you would have seen that upside. Okay, right there again, where support becomes resistance, stay long. It tells you to stay long. It also, gives you that if you're in that investment, stay in it, and so onwards. If that was breached, that support, that is key resistance that then becomes, that says stay long. And for as long as your resistance levels, remember, you're carrying through these lines from previously, once they're breached on the upside, it just keeps saying stay in the investment, stay in the investment. or if you're looking for a new buying opportunity, when that resistance is reached, just stay, you can then get in. The hint when it comes, when you look at your RSI, the thing that you should keep an eye on is if you see that the RSI is dwelling, or it tests oversold a lot, then you know that sentiment is generally bearish. And when it starts changing and it's now starting to test a lot of oversold, overbought, it's in overbought territory a lot, then you know that sentiment is starting to change from what was previously, because when it is oversold, when it's bearish, it tends to hit oversold quite often. And when it's bullish, it tends to test overbought quite often. All right. How do you predict price movements with just basic technical analysis? Those trend lines that you've been drawing and the support and resistance levels we're drawing are the ones that tell you where prices is likely to go. So that's why I say carry them through, because when there is a change in sentiment, you then know that the next level it's trying to go is the resistance level if it's bullish, or if it's bearish, where it's trying to go is the next support, So if, for instance, with that resistance breach, you'd know it's going to the next resistance level. When that is breached, that's the next resistance level. So you already have an idea of where it could go in price every time resistance levels are breached. Then there are times where the support level gets breached, okay, you would know that. If that support was breached, that would have given me a sell, which would then mark the end of that uptrend and a potential downside that's going to come in. And in the downside, you then know, okay, so that's at 12 Rand. That means the next place it could fall to is 8 Rand. That's the previous resistance becoming support. And if it breaches that, the next it's going to go to is about 5 Rand. It's there. So you already know. And that's what I like about technical analysis is, you know, it's pretty much, you feel like a fortune teller, but not really. It's just prices that have been there. Okay. So for a long-term investor, I think using basic technical analysis is really sufficient. You don't have to get all complicated about things. You're just looking at when, because you're obviously only buying when you're a long-term investor. So you're really looking for shares that are breaking out of bear trends, waiting for that. Because be honest, who's been waiting for Sasol to turn? Isn't this, have we not been waiting for this? I mean, every time when it went through 100, I was like, come on, Sasol. That's what we've been waiting for. Now there's been a turn. Now, and at really low levels. I mean, who would have thought Sasol would fall that far? Listen, this is a nice investment, retirement annuity funds, share Sasols. But because we've all been waiting, and every time it breached its support levels, we knew it was not the time to be getting into the share. But now it's breaching resistance levels. Now it's telling us that sentiment is changing. So long-term investor basic technical analysis is actually sufficient, because it tells you what the predominant trend is, and it with your support and resistance, it tells you when you should be entering or exiting the markets. I have a few, you know, there's, especially when you're investment, I've always said to my clients that you're never in the trade or the investment of a share for the long term. You don't buy thinking, I'll sell it when I'm 60 something. You know, it's a long-term investment. You're in that investment for as long as the uptrend is intact. The minute that uptrend changes, you need to learn to sell, because then you're not investing cleverly. You're just, so when people say, it's just a long-term investment, it's not, because that trend could be, it could complete a 100% retracement and go up in a year and then pull back down 100 and something points, because that's how the market is. So you're in for as long as the uptrend is intact and until sentiment starts changing. But for an advanced traders, they want more sophisticated, specialized way of analyzing market sentiment, because they're getting in and outs. They're not looking for long-term investments. So that type of analysis, where it's just looking at the RSI and all of that, is not enough for them. You know, it's a bit boring. They need some format. They need something that's giving. So they would want something that's a bit more sophisticated, and it does get sophisticated. And that's where we get to the advanced technical analysis part of things. Now, Traders of all skill types can use advanced technical analysis, but the active traders, which would be your day traders, swing traders, or even professional institutions, they want to use advanced techniques to find real-time opportunities, to be able to manage the risk, and to gain insights on market psychology. So they would want something that's a bit more intricate. They use sophisticated tools like complex chart patterns. And in that, there's things like head and shoulders pattern, double tops, which I'll show you in a second, triangles, and that assists them to know what is happening with sentiment and where that particular asset you're trading is going. Then they want sophisticated indicators on top of that. And that would then, with that, it's more complicated, and they give a more in-depth analysis on that market sentiment. So the advanced part of things would be using patterns and using more sophisticated indicators. I'm going to start off with patterns, and I'll kind of not squiz through it, but just show you what are the patterns that are available. And once you know these patterns, when you're trading and they pop up, you know exactly what your trading strategy will be. And that's the cool thing about knowing every type of pattern. They're not too many, but at least know them, because that helps you with the trading strategy. So the reversal patterns in an uptrend. This just simply means that a share, whatever instrument is trading, has been going up, and then nothing goes up indefinitely and nothing goes down indefinitely. When that trend gets exhausted, there are certain patterns that form. And if you concentrate, if you learn your patterns, then when they form, as I say, you then know that, oh, okay, this is the end of the road with this investment. I need to get out, or this has now reached the top, the lower end, and it's time for me to get in. So the reversal patterns will then dabble between a double top, head and shoulders, and a rising wedge, which can also form in a bear trend, but when it forms in an uptrend, it actually means it's a reversal pattern. Okay, and then those are seen, although they form in a bull trend, they're known as bearish reversal patterns, and they indicate that the ongoing upside momentum is starting to lose steam. You want to know that information because you want to get out when it's losing steam. You don't want to be invested in something that's going to pull back. And because of that, once that pattern is confirmed, it gives you the sell signal. And you only act when the pattern has been confirmed, not when the pattern is forming. You might do yourself a great unjust. I've done that before, thinking, oh, this has got to be the head and shoulders. And then it breaks on the top end, and I've already closed my position. So it's always best that you then wait for the pattern to be confirmed. Then there are reversal patterns in a downtrend. And they're just the opposite of the other ones, which would be the double bottom, inverted head and shoulders. A falling wedge also forms in a bear trend, but when it in an uptrend, but when it forms in a downtrend, it means it's a reversal pattern. And those are known as bullish reversal patterns. They are seen as a shift in sentiment. So if something has been falling for an extended period and these patterns form, it then means that sentiment is starting to warm up. And usually a lot of these patterns that form is when institutions are also trying to just get their monies out or get their monies in. When that pattern is confirmed, it gives you a buy signal, like how we've been waiting for a couple of buys. I mean, I waited for platinum buys. Now the property shares are also doing pretty well. Like, we've been waiting for these buys. They formed patterns that gave us those buy signals. Then there are continuation patterns. And the continuation patterns are the ones that encourage you to still stay in that uptrend or that downtrend is still in place. And those range from rising wedges, bearish triangles, or bearish pennants. They just simply say, even if I'm forming, once I'm confirmed, it means I'm going to continue forming. But as I say, nothing goes down indefinitely. There is that little, and sometimes it's a little bull trap for they form and one thinks, oh, it's a reversal when it's not a reversal. And then it's just a continuation. So it's kind of one of these. That's what forms those peaks and those peaks and troughs. So it suggests a temporary pause. Don't get too excited. I'm going to continue falling once I am confirmed. But if the opposite happens, then that, like for instance, the upper end of whatever is forming gets breached, that then says, okay, that's a change in sentiment. But otherwise, it's a continuation. That then says you should stay short or sell if you were looking for a selling opportunity. Same happens with continuation patterns on the upside. These would be seen as bullish continuation patterns, where there's a falling wedge, bullish triangle, and a bullish pennant. That advises that the uptrend is likely to resume. So if you're in a trend, if you're in a share, and I always think that these patterns form because of overbought or oversold positions. They cause that downside, and when they start coming upwards, then it gives you an opportunity. I always say when a pattern forms, it gives me the opportunity to reload at a cheaper price. So I get really excited, particularly when I see a falling wedge. I get really excited and wait for that breakout. I'm like, this is the time I'm going to get in and reload. So if you're in Sasol or anything, I'm talking about Sasol a lot, but if there are any falling wedges that form in the current uptrend, no, it's an opportunity to reload and not to sell, okay, because there would be a counter trend. Then you have that, so when it's confirmed, it gives you a strong buy or a stay long if you're in. The bilateral patterns, really, you never know how they're going to break out, either upwards or downwards. It's a consolidation. It's an indecision point in the market. But when the upper slope is breached, or it gives you a buy. When the lower slope is breached, it gives you a sell. But in order to know where it's going to break out, you never know unless you're using an indicator. And an RSI is perfect to tell you in advance whether the breakout is going to be on an up end or the lower end. And that's why I'm totally besotted with the RSI. So they indicate very high market volatility, uncertainty in price, and suggest that price could move either upwards or downwards. And the only way you'll prepare yourself for an upward move is obviously putting your support and resistance. And once either level is breached, you then know what direction it will take. An upward break would then give you a buy signal, and a downward break would give you a sell signal. Now, how do traders predict future price movements using patterns? Now, let's just look at the reversal patterns, and we'll start off with a double top pattern. Double top always means it's tested a level twice but failed to breach it, and then there is a trough, which is also known as a neckline, that once that neckline is breached, you then calculate the high of that double top to the neckline, subtract that from, so it's a difference with that from the neckline downwards. So if that is 5 Rand and that is 2 Rand, it's a 3 Rand move, you will then expect it to fall by 3 Rand. Okay, so that's how you know. So once the pattern is formed, you can literally say, this is going to go to this price. I mean, people ask me, how did you know, Moxima? I'm just like, but I know I calculated the pattern breakout. All right, I'm just like, it just comes to me. Head and shoulders is also the same, but with the head and shoulders, you literally, it's like a head and shoulders. And you really never know when a head and shoulders is forming until the final shoulder forms, because then it is lower than the head. I mean, you can't have your shoulder up there. If it ever, so what it would happen is the shoulder peak will either be the same as the previous shoulder, slightly above, slightly below, but never closer to the head, because then it's not a head and shoulders, it's probably a double top. Excuse me. Also, with the neckline being identified there, and how you measure what the future price movement is from that breakout, it's from the tippy top of the head to the neckline projected downwards. Like I'd say, if that's 5 Rand, that's 2 Rand, you would know that it would be anticipated 3 Rand fall. And rising wedge, a bit complicated, but you would take it from the base, the difference of the base, and then you'd calculate that from the entry point downwards. What I like about wedges is they give you 2 types of price predictions, the base, and then at some point it's from the start of that trend to the peak to where the base started to form, projected there. Now that gives you, when I see wedges, I know the profit is going to be big because of the calculation. Also know that the longer a pattern forms, the bigger the breakout becomes. But you have to wait until that pattern has been confirmed. Please don't say, I mean, it's a resin. I mean, this is what we anticipate. No, you have to wait for it to be breached, and you have to find an entry level and a stop level, so that's how you prepare. That's what they say. when they say a trading strategy. Once the pattern forms, you already know it's forming, you're waiting for it to break out. You have to find where, if you're wrong, then that's you'll be stopped out there. But if you're right, this is when you're going to get in. Okay. Bullish continuation is the same, the base, projected entry point upwards, otherwise from the top of that to where it started. Flags are also similar, and it's seen as a flagpole. That gives you higher profits once you can calculate it. They're giving you a TP2, take profit 2. So the base would be take profit 1, take profit 2 would be the length of that. Same with the bullish triangle. The first take profit would be the difference between there and then from there to there projected upwards. Same with the bullish pennant, the base. And because you know that these are continuation patterns, you obviously know that, okay, the upside is likely to go towards there if you know, once it's confirmed. And also gives you a higher TP because of that little flagpole it forms. Now, I just want to show you how it works on a chart. So obviously you then draw your trend line, because you know the first point of reference is if that trend line, if a share starts teetering on the trend line, it gives you that caution signal, unless it starts lifting off the tarmac like a plane would lift off. But then you see there and you're like, whoop, it's failed to breach that twice and it's formed a trough. It's giving double top already, right? Now your trading strategy starts. Okay, so once it trades, okay, so it's traded through the trend line. I don't act when it's traded through the trend line. It just says to me sentiment is changing. But when support is breached, so you've got the double top, when that is breached, it means I have to sell. Okay, that uptrend has reached its end. I need to sell. How do I calculate where it's going to fall to? You take the difference between the tippy top, the high point, to the trough projected downwards. And indeed, it does fall towards there. And then that resistance, because this was resistance, that then becomes support. And then you still, you know, you're out of this investment, for example, or you've short as a trader. Now you start seeing the resistance being support. It means, oh, it means I need to still stay short here, or I can't get into this investment yet. Then it starts forming these rising bottoms. And you've got this horizontal line. What is that? Oh, that's an ascending triangle. An ascending triangle can sometimes be a bullish continuation. It could mean a reversal in pattern. If the resistance level is breached, it means, oh, now it's a time for me to buy. But if the lower slope is breached, then it means it's not the time for me to get in. The lower slope gets breached. It's not the time for you to get in. So we wait. So you wait. This is another share that I've been waiting, Grindrod, for it to turn, and it has turned, and you don't want to miss out on this investment, just as a little tip. How do you know where it's going to fall? The base projected downwards, and then indeed it pulls back. It forms support there, and as it's forming support, it starts forming the rising bottoms, but it's also encountering resistance. It's not trading through that ceiling. But if that itself then tells you this is sideways. When you have support and resistance, it's a sideways pattern. You draw your trend line, and in that sideways, coincidentally, it starts trading out of that trend line. So that's like sentiment is starting to change. Therefore, when this resistance level is breached, that's a time for me to buy. And when I buy, because remember this part is not there. Okay, so then you think, okay, it's time to buy. It's likely to go back to other resistance levels, but what is my immediate price that I can get from this pattern breakout? Sorry, just to point out, if you were in this investment, which is the reason why I say you need to learn how to sell. You're not in the investment for the long term. You're there for as long, that's the only time you've got the long part. You're there for as long as the uptrend is still intact. This double top would have saved you, if you were in this investment and you got out at that price, it would have saved you an 88% drop in the value of your profit. So, you know, when these patterns form, it's not just for it really gives you that information of when to start getting out and taking your profits. You would have taken up your profits and started looking for a share that's going to give you upside. instead of thinking, oh, maybe it's going to rise, because that's what happens. Okay, maybe it's just 10%. Okay, maybe you only start freaking out when it's a 30% drop. You're like, oh man, what must I do? You should have just looked at the patterns. The patterns were there. You just ignored them. So take heed to that. But now let's go back to our buy. Now to calculate where it's going to go, you take the difference between your support and resistance projected upwards, and it gets there. That support that was previously support becomes resistance. Once that breach says stay long, don't sell this investment. Then it forms a bit of a little triangle there. If that upper slope is breached, it means you must still stay in. Unless if the lower slope was breached, you would have said, look, that's about it, buddy. I'm not going to go any further than this, maybe sell. And that's when you would have sold. So to calculate where it's going to go from that triangle, you take the base and you project it upwards. You've carried on this trend line. Okay, I'm using a monthly chart here. This is a level that was important in 2013, and it's becoming important in 2025. So carry through those lines. They were psychologically important then. They have a psychological effect now. That is breached. It's a key resistance that gives you a stay long with potential upside. And then you would then know at this point, if you got in there, because that's effectively trading at 5 Rand, it's now trading at 15.80, you would have made 185% if you heeded to that. And there's potential even more upside when that resistance level is breached. It could go all the way back up there, giving you another 82% gain. So you see how the patterns and everything, they give you that information. You just need to learn how to use it. Now I'm using a shorter time period, and this is the gold. This is how traders. Now with traders, they constantly looking for patterns, constantly, and this is an hour chart. If you look at that, in an uptrend, for example, if a bull trend is fully established, you need to start asking yourself, what patterns form in an uptrend that make me stay in this particular trade? It would be sideways patterns that break on the upper end, falling wedges and flags that then give you that thumbs up that this is going to continue with its upside, or ascending triangles. So, or pennants. So in that uptrend, you're looking for those 4 patterns that could potentially form that will give you a re-entry, another time to get in, or to sell if it goes the other direction. So there's a sideways pattern, you project that it's going to go upwards there. There's a flag, you project that it's going to go up. This is what they're constantly looking at, and they're projecting. Uptrend is starting to chill with the trend line too much now. It's supposed to bounce and go upwards. Now it's like having tea with the trend line. What's happening? There could be a change in sentiment. If that's the case, once it's sitting with the trend line, you then start asking yourself, what pattern indicates an exhausted trend? And that would be your double top or your topping out pattern. It would be your head and shoulders or your rising wedge. And already that high, the first high is lower than the second high. That's already giving you, oh, I thought I could whistle, but it's already giving you a caution. This is probably going to change. It's forming what is known as a symmetrical triangle. You never know it's going to break upwards or downwards, but when it does breach that trend line, it means sentiment is changing and it's going to break downwards. It starts to form a pattern. If that resistance is breached, it means it's just a little pause, the pattern's going to go up, but if support is breached, it means that's the end of the trend. You need to sell. Then you start projecting how it's going to go downwards from the pattern formations. Okay. So that's just generally how you predict share prices using, because remember, all of this was not there. I'm just showing you what was there. But when it's not there, that's how you then, but you've literally seen how it goes to those targets. Every time it goes to those targets. You already know in your head how much you're going to be making. Okay. The sophisticated indicators. I mustn't go over time here. So the sophisticated indicators would range from Bollinger bands, average directional movement, and Fibonacci. Okay, so this is what these are what the traders actually just like, and I use them. I really do as my secondary indicators, but I really like keeping things simple. So Bollinger bands are simple. It was developed by John Bollinger in the 1980s. All of these were developed right now, and it is an indicator that uses a standard deviation where you've got the upper upper and lower band that moves within a certain time frame, and those bands then tell you whether the whatever you're trading is overbought or oversold. Overbought is when the prices are nearing the upper end. So then a trader knows that, okay, that's overbought. I should start looking to sell. There may be a change in, prices may fall. Oversold is when it's trading at the lower band, and that's when you should anticipate a rise in prices. Bollinger Bands, I think Bollinger Bands and RSI are the most faithful reading changes when there is a ranging market. Ranging market is when there's just there's none trending. It's just moving sideways. There are a few shares, banking shares have been in ranging markets at this point. And these indicators can then help you to know whether that momentum is starting to rise or not. So this is basically how a Bollinger Band looks. And the upper part will be overbought, expect a pullback. Oversold, expect a recovery, but the middle one is known as the center line, also is a moving average. And that crossover of that gives traders signals. So Bollinger Band in a trade ranging, you would sell when it touches the upper slope because it's overbought. And then some traders close when it trades through that center line. I think it's just an indication to actually just stay in that short position. But some traders, they would then close when it reaches that middle line. And they would then buy when it's oversold. And then when it reaches that center line, they would then close their positions. But I still think it's an opportunity for you to stay in. In a longer time period, which I'm using longer time day chart, you can see there it says sell. Some traders would get out when it or close the position when it crosses there, but some would then stay in until the lower band is tested. That's where they would buy. So they would sell, buy. Now, because it then tests this, because every time you test the low band, you think, oh, it's time for me to now close the position. That's when the trend lines work. You can't use indicators independently. You still need the trend line drawing and the support and resistance. So as you can see there, when it bounces there and trades to the trend line, it then gives you that buy signal. Oops, it then gives you that buy signal. Shorter time frame, it looks a bit more busier, but that's an hourly chart. You can just see the buy and sell signals that it just keeps giving you. That's what traders want. They want that, when should I get in, on a shorter time period, not on a day chart. They look at the day chart because it gives them, more leverage, but they would know when to stay in a position by looking at the day chart, but they would enter the position on a shorter time period. But so sell when the upper slope is breached, buy when when it's tested, and then buy when the lower slope is then tested. And that's how it goes there. What you need to keep an eye for when you're looking at Bollinger Band is when there is a contraction, particularly a squeeze. It always comes that way. It's a contraction, squeeze, and when that squeeze is done, you have a breakout, either upwards or downwards. Okay, so in other words, that would be the contraction, squeeze. That indicates that's the squeeze is when there's low volatility, and then there's that breakout. After the squeeze, you have that breakout. Okay, so contraction, squeeze, breakout. Contraction, squeeze, breakout. That's literally what you're looking for in Bollinger Bands. Contraction, squeeze, breakout. Okay. When you're using Bollinger Bands, trade in a downtrend, you expect prices to fluctuate more on the lower end. So if it's in a downtrend, you're literally, what your trend is going to do is fluctuate on the lower band and between the lower band and the middle line. And when the middle line is crossed, that means that sentiment is changing. Okay. That gives you a buy, and that means you should then be getting out of that short and going into a buy. And in an uptrend, prices will trade more, closer to the upper band and the middle part. But when the middle center line is breached, that gives you a you need to sell indicator. Okay. And that's when you would sell. So in other words, with that trend line, oopsie, okay. So when that is breached, it's been on the downside. When that is breached, it gives you the buy. Okay. When that is breached, it gives you the sell. When that middle part is breached, it gives you the buy. Okay. Squeeze. There we go. Was that too fast? It's good. Okay, cool. My dude again created the average directional movement index, and this one measures the strength of the trend, which is something you want to know. How is this trend? Is there Vuma, or is it losing? You know, it's like, is it an uphill that's going blah, 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 or is it just speeding through that? This is what will help you with that. So it measures the strength, not the direction of the trend, the strength. So for example, if it's trending strongly weekly, or it's just trading sideways. So it allows traders to apply, you know, appropriate trading strategies with that. So if it helps them with trend following or range trading. So just know that the ADX line shows you the strength of the trend. When it's used in conjunction with the directional movement index, which is the DMI line, that then gives you the buy and sell signals. On its own, it's just giving you, is this uptrend strong or is it weak? And by that, you then get the DI lines, DI minus and a DI plus. It just helps traders to know whether it's worth getting into the market, or is everyone just trading blindly, okay? So this is just to identify that the ADX line would be that purple. That only tells you the strength and not that the price is falling, because this could fall and the price is going upwards, but it will just, when it starts falling, you will then know that that trend is starting to lose momentum. So strength of the trend, not direction. When it trades below 20, it then means that the market is really trading sideways. It's not doing much. When it starts trading between 20 and 40, it means that momentum is starting to pick up. At 40, above 40, it just means that it's developed a strong trend. Most people like it when it's at 40, and let's stay in the trade for as long as it's trading above 40. Now, the primary, the DI line is similar as the RSI crossover, shorter period and longer period. So if that crosses over up, you know, crosses the, so this crosses the, if the DI crosses the upper, well, the minus, the D minus DI, then that gives you a buy signal. But that's the DI plus is the one that gives you the signals to either take on the position or not. And it has to be done with a crossover effect. Okay, so AX gives you the strength, the DI, the plus MDI gives you the signals to buy or sell. And how it's calculated, it's just the current price and the previous high, and it uses the average true to create this green line. So it's a bit complicated. You don't have to do it. I just thought I should explain it in case you want to know. The the minus DI just gives you, is the more lagging one. There needs to be a crossover for a signal. So that's how the minus DI is then created. So the recap is ADX used to determine whether the market is ranging or consolidating. It's the strength of the trend. These two DI lines, the minus and the plus, determine whether they give you the direction of the trend and whether you should be buying or selling. Also there, as you can see, when the DI crosses on the up end, it says it's in an uptrend, and if it crosses it from the downward side, it then tells you that it's in a downtrend, giving you the buy and sell signal again. It's all about crossover. So if the plus crosses above the D, it gives you, and your ADX is rising towards 20, that's a signal that you should start buying. See, a bit complicated. It's not like the RSI, but once you know it, once you learn it, it becomes a bit easier. And the sell signal is the opposite. When the plus line starts crossing, goes below the minus line, and your ADX is falling, then it means you should start, that upside is starting to lose momentum, you need to get out. And it happens with the downside as well. So effectively, if the ADX line is falling, but your plus DI is rising, it doesn't mean you shouldn't get into the position. It just suggests that the strength of the existing trend is weakening, but the buying pressure there's buying momentum that's coming in, because that's what you want to know. Is there buying momentum coming in? And if they're both falling, then it means that there is a complete change in sentiment or complete change in trend. Okay. And then traders should consider selling. But you can't use these independently. You have to still draw your trend lines and your support and resistance levels in order to know when to be getting out or getting in. So in other words, that was a crossover there. Your DA was below 20, but it was rising. That gave you a buy. And once it breached that resistance there, can you see it's starting to rise? That says stay long or buy. And it does rise. And then at that point, can you see it starts to say that, okay, that momentum is losing steam. So consider selling. And when the crossover effect happens, around this starts to fall. And when that crossover effect happens right there, it then means you need to sell. So that is known as bearish confluence. Everything there, trend line breaching, support level breaching, crossover, those are all confirmation that sentiment is changing. You need to heed to that, not be like, well, it's just saying that. It's telling you the information you need to know to get out of the investment. Right there. And it falls. So let's look at a shorter time frame, which would give you a buy, the crossover. So you're just looking for the crossover of the plus and the minus DI lines, and the ADX is just telling you if the momentum is strong or not. Okay, so even if it's falling and there has been a buy crossover, it doesn't mean there's confusion. It just means, you know, even if I'm falling, it will start picking up momentum because then it rises. It's also quite prudent to draw trend lines on your DI line, on your ADX line, just to assist you to know if there is, see when it starts at this point in time where it is heading to a top, that crossover then would have told you to sell. So there are a lot of things that you see how the advanced technical analysis, you have to apply a lot of other things to give you confirmation. Traders love this. They need it. They need that intricate yes or no, because they are making money by the minute. It's not like long-term investors who are going to be there and just watch. You're like, oh, it's still rising. Let me stay in. Oh, it's still right. Oh, it's breaching resistance now. Let me stay in. They are in and out, you know. So yeah, that's the that would have given you all of that information on when to sell is given through crossovers, and your ADX would then give you that. Lastly, we're going to look at Fibonacci, and I'm going to keep it really simple with Fibonacci because it could get a bit complicated. Its percentages used. I'm sure you've heard about Fibonacci and the golden ratio. It gives you support. Now, what Fibonacci is good for is support and resistance levels. If you cannot identify them, you can at least use Fibonacci to help you with that. All right. The most important retracement levels would be the 23.6, 38.2, 50. Not so, it's not used as much, but it's considered. But the key one is the 61.8%, which is the golden ratio. I'm sure you've all heard of the golden ratio. Everything that's designed, our hair, the leaves, all have to go with Fibonacci. Fibonacci, kind of the calculation of Fibonacci. I don't know if you've seen that little spiral thing that forms. So they use it in technical analysis as well. It's to anticipate where prices may pause or reverse during a trend. As I say, it's excellent for support and resistance levels if you can't identify them. So how it works is you'll, in an uptrend, once there's an uptrend, you'll then going to try and find your swing high and your swing low. Because in that uptrend, when that uptrend gets exhausted, you need to know how far will this fall before I can get in, or when should I fall, or when should I get out, and when can I buy back again. So once you've identified that, which would be your swing high and your swing low, this is now zoomed in on that swing high and the swing low right there. So you draw your Fibonacci starting it from the low to the high, and this just automatically draws on its own. So those would be the levels there on the side. The most commonly watched zones would be the 38.2, and I'd say the 61.850. Not too many people, they consider it, but it's not that big. But the 38.2 is important, and the 61.8% is important because that's where the golden ratio is. So what the retracement meanings are is that when the 23% gets breached, it means it's a shallow pullback in the strong trend. So if you've had that strong upside, it may just pull back. If it holds at 23, then it's just a shallow pullback. It can go then back upwards. But if it breaches that 23%, then it's likely to go to the 38.2%, which is often seen as where traders would buy. It's the buy dip, all right? But once breached, it then means, oh, no, we're not meant to buy it. It will then go to the golden ratio, which is the key decision making. You'll always see at 61.8 sometimes there's a lot of muttering that happens at that percentage, because it's that tug of war between buyers and sellers. When it really kind of stops at 61.8, but if it goes further to 78.8, then that's the final leg of the retracement. And if it does 100%, that's 100% retracement. That means it's fallen all the way back down to where it started. So now you identify your swing high, swing low, you've got the percentages there. When this is breached, that's the shallow pullback. When that's breached, it gives you the sell. When that is breached, then it means, okay, well, it may just go to 38.2, and at that level, it may give me a buy. You can see it mutters a little bit there, but it actually trades through. Then you know it's not the time for me to get in, because that would have been the buy dip. But then you know, you could have gone long there, but it doesn't. It actually continues with its downside. And it's 50, as I said, some people ignore it, but the key one is the 61.8, where there is a lot of decision making. When that is swiftly breached, then just know it's going to go to the 78.6 mark. And that's where it should kind of stop. Otherwise, it just goes to 100% retracement. It kind of does stop there. That will be the final leg there. Because Fibonacci is not only used for retracements, you can also predict where it's going to go on the upside. So in this case, it stopped at 78 and it started to, and you draw your trend line, and then it went to 61 point, which is the golden ratio where everyone starts making that decision making. Okay, then it continues on its upside, and that's when you know that it then will go to 50, 38, same as drawing your support and resistance. But this time by drawing that, it gives you the levels without you having to draw them yourself. That's what Fibonacci is done. And once it's done this upside, this particular upside, you then start again. You look for your swing high and your swing low, and right there. And then you draw your Fibonacci. So those levels are the ones that will tell you whether there's going to be a continuation, a reversal, whether you should be buying or selling. But once breached on the downside, it means you sell until, in most cases, I said, the 61.8% is where the decision making. When that's breached, it means there's further downside. You can get in at a lower price. Okay. Shallow pullback, breached, you get to the buy dip zone. If no one is buying at that point, it means it's going to fall to the next support, to the golden ratio, where it's a key decision. If that's breached, then it could go to the final leg. But from there onwards, it should start going back upwards. It literally does work. But then that's when you buy and so on. I hope I didn't ramble too much with these, but this is now the final part where I'm just going to kind of tell you what basic technical analysis, recapping on everything. So basic technical analysis is about trend line drawing in order for you to identify the end of the trend or the beginning of the next. And your support and resistance is to assist you with entry and exit points. Just to recap, if it's a resistance for traders, it's a sell, but once it's breached, it becomes a buy for both traders and investors. Support then becomes resistance, and then the same happens on the downside. Okay. Basic indicators would be your moving average, which smooths out the noise, but the crossover effect is what gives you the buy and sell signals. You buy when prices cross from bottom upwards, then that's a buy, and when they fall through that moving average, that gives you a sell signal. Another one would be your relative strength index, which identifies overbought and oversold conditions. When it's overbought, don't buy because prices are likely to fall. When it's oversold, don't sell because prices are likely to go up. Okay. Positive and negative divergence is one thing that I love technical analysis. I mean, sorry, it's the RSI for. And just to show you quickly, just concentrating on that particular period. When your RSI forms those falling tops, whereas the price is going up, if you look at the time period, it would have told you around that top there that, okay, I'm not going to be in this investment for too long because my RSI is starting to diverge. That's what tells you that, that's what you know as divergence. And it happens on the other end as well in a bear trend. So that would have said prepare to sell. And also when you draw trend lines on your RSI and you have your RSI breaks out as well as on your price chart, that is double confirmation, which is what you need, that you should then get into that. And it's also known as bullish confluence. So if your RSI has been in a bear trend and your trend has been a bear trend and RSI breaks out of the bear trend, you best believe that your price chart is also going to break out on the upper end. Okay. Advanced technical analysis gives you deeper insight into market dynamics using sophisticated indicators and tools. And they also use to identify trends and reversals with greater accuracy. They also help you with predicting future price movements, leading to just enhanced precision and better risk management, because you then know what you know when you should be selling the investment or that trade if it breaches through, or your your indicator starts telling you to sell. Fibonacci retracements, they identify support and resistance, if there's going to be a reversal or a pause. It gives an indication of whether the market, where it could retrace to, if it's trending or if it's reversing, and it's based on the Fibonacci sequence. With the average directional movement, it gives you the strength of the market, not the direction. It tells you whether that, not strength of the market, of the trend. It tells you whether that trend is strong or weak. Non-directional, it's non-directional, so it's only showing you the strength. Remember, don't get confused where it's falling and you're thinking, oh, I need to sell, it's falling. It's not that, okay? Or it's rising, and because it could rise. So if your price is falling and your ADX is rising, it means that that bear trend is kind of strong. Okay, so don't get confused with that one. The function of the RSI is it identifies where market price could retrace. So what you're going to be looking for is entry points, stop loss orders, and price targets just by using Fibonacci, those percentages, as I mentioned. Just know what those percentages do. Then it's easy for you. You'll be like, okay, it's going to go to this percentage. Okay, oh, now it's trying to rise. It means, all of that. And with your directional movement, especially above 20, it means that this trend is strong. If it starts moving below 20, it means there is either the trend, it's getting weaker, or there may be now sideways movement that you should anticipate. Okay, so it helps traders to avoid trading weak trends. Do you get what I'm saying? So, or non-trends. You'd never want to be trading something that's just moving sideways. It's just fruitless exercise. For me, if it's moving sideways or even in an investment, if it's been sideways for at least 2 months, it's not worth it. I've missed out on upside on another share. Okay, ADX will tell you that when you're thinking of getting in, if it's below 20, it means not yet. Just kind of wait for it to rise a little. That means momentum is picking up and more people are buying or selling. Bollinger Bands just identify overbought and oversold conditions. And what you're looking for is the contraction, squeeze, breakout. Remember, contraction, squeeze, breakouts. Okay, contraction, squeeze. Love doing that. I'm like, where's the contraction, squeeze, breakout? In conclusion, there is, as I said, a plethora of these indicators out there. I think TradingView has about 100 that are built in. You just need to find one that resonates with you, and you need to master it. Don't try and use multiple indicators on your chart. It is very confusing. Try choosing 2 and master them, because I love the RSI so much. You think I'm the one who made the RSI. I can tell you what the RSI is going to be doing. I know how it flows because I've been using it for years, and to me, it's reliable to me. It's made me money. And yes, I will use the ADX just to check other things, or the Bollinger Band, but the RSI just does it for me. Okay. That is what will help you become a successful trader. So in all of that, choose the ones I've presented to you are the ones that most people use. And you kind of want to use the ones most people use because you want, it's a psychological game. And it is also crowd. It's what the crowd is doing. You don't want to go against the trend or against the crowd. So try and use the ones I've suggested or I've just presented and learn them, master them, and you'll do well with your trades and your investments. Okay. Hope I didn't ramble. Thank you.
Thank you for parking there. If you've got questions, come chat after. We've run a little over, and I appreciate some folks' places to go and things to be. Moxima, always.
Thank you, Si.
Appreciate your time. I'm going to say hopefully we'll be back in the proper venue next time. I'm making no promises. Back in the 16th, we're going to be doing investing like I've. Thank you very much, everyone.
Cool. Sorry.